Can everybody see my screen? Yes, 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 yes. Okay. Okay, perfecto. Okay, so like I said, today's class is going to be mainly talking about trading, psychology, risk management. These two things are going to make sure you're actually profitable in this forex market. So before I even go into the risk management things, because I know a lot of you here, you don't know how to calculate your risk. A lot of you here don't know how much you're risking per trade. A lot of you here enter trades and you just don't know what you're doing, basically. Let me just put it like that. Some of you don't know what you're really doing. Even though, yes, you're using the right lot size, you're not tracking what you're making, you're not tracking what you're losing. You know, a lot of things basically. So I'm going to address all of it on this call. So please, again, stay to the end because, like I said, if you just make sure you stay to the end. That's just all I'll say. Make sure you stay to the end. I only accept people that, were in the call. Maybe network took them out or something. But yeah, let's get started. So first and foremost, guys, you need to make sure your trading psychology is in check. And when you're talking about trading psychology, what does it basically mean? It just means simply, in simple terms, you know, the building blocks that form your trading habits. Let me put it like that. The building blocks that form your trading habits. Now, all of us have, certain things that, form the way we trade, the way we execute trades, when we, close in profits, etc., etc. So you want to make sure that the building blocks that you have around your trading psychology are, actually good building blocks. You want your foundation to actually be strong because if you build, your trading psychology on a bad foundation, what do you think is going to happen? You're going to end up, taking a lot of L's. You're going to end up not being profitable. But if you have a good foundation, you're going to, end up being very, very profitable and you're going to make, good money for yourself. So what are these building blocks that we should actually, address? What are these building blocks that we should actually, address or we should, build on that actually good? So first and foremost, you need to make sure your risk management is in check. That's the first thing. You need to make sure your risk management is in check. That's the first building block. Like when you say, okay, I want to start trading, and what should I learn? Risk management should be one of the first things on your list. Because if you're not able to manage your risk properly, you are going to end up, even if you make money today, you end up losing that money tomorrow. If you can make $100,000 today and end up losing everything tomorrow if your risk management is not in check. So you need to make sure you have proper risk management. Always know how much you're risking. Always know how much you stand to gain. Know if it fits your account size and so on and so forth. And we're going to be talking more about that in depth, once I finish this. Another thing as well you need to make sure you have in check is make sure you are not a hate watcher. This one is very, very important. You need to make sure you are not a hate watcher. Now, what do I mean by hate watching or being a hate watcher? This is basically people that, you know, let me use an example in the chat box now. Let's say Hunter. Let's say Hunter. Let's say Hunter made $2 today. Let's say Hunter made, oh, sorry, not $2. Let's say Hunter made $20 today. And, he sees Nessa. Nessa dropped her results. And Nessa was able to make, $500. Hunter could look at Nessa's results and not necessarily get jealous, but would start thinking, why is Nessa making more money than me? He will start overanalyzing Nessa's results rather than focusing on his own results. He's overanalyzing another person's results. You see somebody drop, $2,000 in the charts, and you think, oh, you too, you should be making $2,000. But you just started trading maybe a couple weeks ago. You don't know how long that person has been trading for. You get. The reason why I'm mentioning this is that some of you might not experience it now, but in the future, you might experience it down the line where maybe you're not seeing the results that you want. Maybe you're only making $20, $10, $15, $30, and you're seeing other people drop big results. And in a way, you start to feel bad. And that feeling can now lead you to do things that you know you're not supposed to do, such as using bad risk management, such as you know, using the wrong lot size when trading. So many things can be, so many things can just happen just based off of that feeling of, hate watching, looking, comparing yourself to others. This is something that you should never do. Never compare yourself to others. Your day one is different from another person's day one. You understand? Just because of you see somebody making $2,000 today, that does not mean that you cannot make $2,000 tomorrow. Enjoy your process, because at the end of the day, everybody's journey is different. You can you can be making $20 today, and another person that maybe you guys even started at the same time is making $2,000 their first day. But you can surpass that person, in the next couple of months. You don't necessarily have to rush the process. You don't necessarily have to say, oh, I need to start making the same amount of money that this person is making now. No. Enjoy what you have. Be grateful for what you have. If you're making $20, be grateful for that. If you're making $50, be grateful for that. If you're making $100, be grateful for that. Because at the end of the day, this was my own mentality when I first started trading. If I can make $2, I can make 20. If I can make 20, I can make 200. If I can make 200, I can make 2,000. It's just a matter of time. It's not a matter of if, it's not a matter of maybe, it is just a matter of time. So I know that I'm going to get to those big figures. I know that eventually I'm going to start taking trades that are going to make me, $50,000. I know I'm going to start taking trades that are going to be making me $100,000. I just know that I just need to get there. I just need to be consistent. Eventually I'm going to get there. So if you're making $2 now, you're making $30 now, you're making $50 now, don't feel discouraged because you see another person dropping, $2,000 or $3,000 or $5,000. As far as you are consistent, you will eventually get to that level and even surpass that level. So don't let that emotion lead you to do anything stupid, such as over risking, such as using bad risk management, such as using the wrong lot size, and so on and so forth. Make sure that if you are trading, you are sticking to your own process and not another person. Don't follow what another person is doing. Stick to what you follow your own path. Like, don't look at another person's trading account and try and compare it to yours. Have tunnel vision with this your journey as a trader. And trust me, if you have that tunnel vision, you are going to end up being very profitable long term. So that's something that you should definitely work on. If you struggle with right now, definitely work on that, because it's something that you might not experience it now, but in the future you might. So you need to work on it now, and trust me, addressing it now is going to be a huge plus for you. So next thing is to stick to what works once you find it. This one is very, very important. Stick to what works when you find it. So if you find a system that is already making you good money, if you find a system that if you find a system that is already making you good money, you find a system that is already, profitable, you don't need to go and start trying to change this. Now, this one is not necessarily for you guys, because most of you guys just copy trades. This one is mainly for people that, want to start analyzing the markets by themselves and actually be independent traders. You know, you're going to get to a stage where, you eventually find something that works for you. The best thing you can do in that situation then and there is to stick to it. Don't overdo. The funny thing about trading is that you shouldn't always try to change something. I don't know how to explain this, so because it's kind of a funny situation, because yes, you should always look to improve. You should always look to improve, but once you find something that works, stick to it. Like, don't try and start looking to add what doesn't need to be added, basically. Like now, for example, if you're cooking, this is going to be a funny analogy. If you're cooking jollof rice now and you see it is already sweet, there's no need for you to go and start adding 100 other different spices, because of you see other people, adding 100 different spices. If your jollof rice only requires three ingredients for it to be sweet, stick to it. If it is tested, approved, and trusted by you, stick to it. Some people, they might need 50 different ingredients for the jollof to be sweet. But if you only need three, you don't need to overdo. If you found your formula, stick to it. If you have found your formula, stick to it. Don't try and overdo. Don't try and, you know, do what doesn't need to be done. You get. So that's another thing. So that's mainly for people that, are eventually going to start analyzing, start, trying to make money for themselves independently. Then the next thing is, having a trading plan. Now, this one is very important because I know a lot of you just wake up in the morning. A lot of you just wake up in the morning and you just open the market, and whatever the market gives you, you collect. Whatever the market takes from you, you just go with the flow. You go with the flow, basically. Most of you just go with the flow. You're not planned, you're not organized. And that is something that you need to really, really work on if you want to be profitable. Okay, somebody asked a question. The strategies not become obsolete over time. Now, this is, like I said, there's a very fine line. You don't necessarily have to change everything that you're doing. You just have to add minor improvements. You always look to refine, not to change. You get. You look to refine, not to change. So there's a fine line between, changing and refining. Some people think, refining is changing, and it's not the truth. Me personally, I'm like the strategy that I've been using since 2022. Sorry, 2023 rather. 2023, I'm still using that strategy to today. Now, does it mean that the same way I was trading in 2023 is the same way I'm trading today? No. I am still using the same strategy in the sense that, the foundations of my strategy, such as, marking out key levels, following the trend, Fibonacci. I still have my foundations, but I have refined it over time. In 2023, I was not using a break of structure on the minutes time frames for me to get my entry. I just used to, allow Fibonacci to tap. I just allowed the market to tap my Fibonacci level, then I enter. But as time went on, I discovered that, if I use a break of structure, I wait for a break of structure before entering the market. When the market gets to my Fibonacci zone, I have a higher win percentage. That is what you call refining. Now, I did not say, let me stop using Fibonacci and let me just use, other blocks and liquidity and all of that. No, I didn't change my foundation. I simply just refined. It's just like you build a house, rather than breaking down the house and building it again, you just do renovations. You do renovations. So I hope that makes sense. I hope that makes sense. So figure out the type of strategy you want, like immediately, as fast as you can. Then refine as time goes on. Because at the end of the day, all strategies work. Let me not lie to you guys. All strategies work, whether you're using liquidity sweeps and imbalances or you're using common support and resistance, it works. Just refine as time goes on. So yeah, that is it. Like, back to what I was saying about trading plan. Yeah, a lot of you don't have trading plans, and it's something you really need to work on. I'm going to share my phone screen in a second and show you guys, a trading plan that can actually help you guys. Okay, I actually have it here. Let me hold on. Okay, perfect, perfect, perfect. So you need to have a trading plan. You need to have a trading plan. It is very, very, very important because when you have a plan, you plan to succeed. If you don't have a plan, you plan to fail. It's as simple as that. If you don't have a plan, you plan to fail. If you have a plan, you plan to succeed. So if you really want to succeed, you need to have a plan. You understand? And this is just a rough sketch. It's a rough sketch. It's not, finalized. It's just a rough sketch. But this is basically how you should be approaching the market every day. You should know how much you should risk per trade, number one, depending on your account size. You should know how much you risk per trade, depending on your account size. You should know, your daily profit target. You should know your daily loss limit as well. Very, very, very important. Know your daily profit target, know your daily loss limits. Before you start trading, you need to know these things because if you don't, you're going to end up making a lot of money and you're going to end up losing a lot of money. So once you reach a particular profit target, stop trading for that day. Once you reach a particular profit target, stop trading for that day. And I guess I'm going to come back to this, but I just want to finalize this section. I want to finalize this section before I actually, come back to it. I want to finalize this section. So yeah, we're going to touch more on trading plan and risk management when I switch over to my phone. Another thing as well that you guys need to fix up is revenge trading. I think I talked about, for those of you that joined my call last week, if any of you joined my call last week, you would know you would know when I was talking about, how a lot of you revenge trade. Like you lose a trade, rather than you to say, okay, I'm done trading for that day, you have already lost a good amount of money. Instead of you to say, oh, I'm done trading for that day, you end up taking more trades, trying to recover the initial loss, and then you keep on losing and losing and losing and losing, saying, "Oh, let me just recover the money that I've lost. That I'm going to stop trading. I don't even want profits. Let me just recover the money that I've lost, and I'm going to stop trading." And you end up taking more losses and more losses and more losses. And then you just say, "Oh, let me just recover, at least 80% of what I lost. I don't even want to recover all the losses, just a little bit of what I lost." And next thing you know, your account is gone. So for you to not end up in that cycle, you need to stop revenge trading, honestly. You need to stop revenge trading, honestly. See, personally, see, I'll be very honest with you guys. Out of all of the things that I am going to list here, this revenge trading is probably the hardest one to overcome. Honestly, for some, I don't know, there's a spirit that just follows it. I don't know. This one, it took me a long time to even, stop it. Ah, if not for bank limits that year, God, waiting I foresee. Waiting I foresee. But no, revenge trading is bad. Another one as well is you make money, you lose the profits, and as you even lose the profits, you're losing more than what you made. So you're now in loss for the day. You now say, okay, let me just recover the profits that I lost. Then now you now lose again. Then you now say, okay, let me just go back to break even. Let me just recover all my losses. I don't even want profits for the day. You now lose again. And you just keep going in that cycle until your account eventually blows. So guys, please take it from me. Take it from me. You don't want to end up in that terrible cycle of revenge trading. It can honestly ruin your life. It's, it can honestly ruin your life. So please learn now. Now that you guys are still in the early stages, learn now. You don't need to learn from your own mistakes. You can learn from other people's mistakes and still get the same lesson. So please, I beg you in the name of God, learn now. Because revenge trading, no, 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 it's just crazy. If like and this is where having a trading plan comes into play. Because if you have a trading plan, you are not going to revenge trade. You understand? If you have a trading plan, you are not going to revenge trade. So please, always follow your plan. Always follow your plan. And like I said, we're going to touch more on that, as we progress in this call. And please, I just hope you guys are also taking notes as well, because these are definitely things you want to write down. And the last but not the least is, this fear of missing out. The last but not the least is this fear of missing out. Now, guys, this fear of missing out, oof, it affects a lot of you. And I see it. Like I see it every day. It affects a lot of you. Why are you guys entering trades when TP1 has already hit? Why? Why? If a trade has hit TP1, don't enter that trade again. If you see you have missed a trade, there's no need, there's no pressure. And I understand why you guys do this, is because maybe, in fact, sef, this is even a funny one. I'll give you guys two scenarios. So the first scenario is, a trade has hit CP1. Maybe you did not see the trade, you were not with your phone, and you now notice, a trade was dropped, and the trade has already hit CP1. You now say, oh, let me quickly enter. Let me quickly enter so I can make some profits. Next thing you know, immediately you enter, the market will immediately reverse. Like it will do a U-turn and go straight to SL the minute you enter. And you see some people posting profits, but you end up posting loss because why? You entered late. Don't enter trades late, guys. Guys, if you see a trade has left you, just leave it alone. There will be more opportunities in this market. This market is not running away. It is open 5 days a week. 247, 5 days a week. This market is not going anywhere. There'll always be more trade opportunities. You understand? But if you don't even have capital to trade with, you cannot capitalize on those opportunities. So preserve your capital. Allow the market to come to you. Don't rush. Don't be in a rush to enter a trade just because of, you see other people posting profits. Wait. Be patient. If you have missed a trade, be patient for the next trade because more trades are definitely going to come. You understand? Now, another one. This is even the funniest one to me, to be honest. This one is the funniest one. So let's say you open your Telegram app. You see a trade idea was posted, but you don't feel like entering the trade. Maybe you're not too sure of the trade. You don't feel like entering the trade. You're not like, okay, let me leave this trade. Next thing you know, you see TP1 smashed, TP2 smashed, TP3 smashed. And you now start questioning yourself, why didn't I enter this trade though? Why didn't I enter this trade? Next thing you know, I say, okay, let me just quickly enter. Let me just, carry to TP4. Next thing you know, the trade reverses and hits SL in the minute you enter. So the thing, this one is that you did not even miss it though. You looked at it, you said, okay, no, I'm not going to enter. But because you now started seeing people post results, you now entered out of the fear of missing out and you now ended up taking a loss. Please, if you have experienced this before, this is a sign for you to stop. This is a sign for you to stop. So please, I beg you in the name of God, let today be the last day, you do something like that. You know, Having a trading plan as well is also going to help you prevent this last scenario that I just gave to you. Having a trading plan is going to help you prevent, that last scenario. Because if you have a plan, you know who you're taking trades from, you know the profit targets you're looking for in a day. Once you hit those targets, you stop trading for that day. So even if somebody drops a trade and he hits TP 100, you're not faced by it. Why? Because you've already made your own money for the day. If you guys are guessing what I'm saying, let me quickly take a look at the chat box and see what you guys have been saying. Mm, 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 mm. Somebody said that it happened to them on Wednesday. Okay. They don't tell you to bad person for results. I'm not even checking my phone, self. I'm not even checking my phone, but after the call, I'll check what they have been saying on the group. But yeah, guys, so these are the things that you need to make sure you get in check if you really want to be a successful trader. You need to get all of these things in check. And guys, I promise you, if you get these things in check, you would be profitable. Like this for me, I'm giving you that I'm beating my chest. I'm beating my chest. I'm giving you my assurance. Samuel, I'm giving you my assurance. If you have all of these things that I've mentioned in check, if you are not profitable, that means you need to go to your village and consult and ask your village people why they are following you, because there's no way you would get all of these things in check and you not end up being profitable. Like it's impossible. No, honestly, it is impossible. If your risk management is in check, you have a trading plan, you stick to what works, you don't revenge trade, you don't have FOMO. What else again? There's nothing else again. Honestly, there's nothing else again. Especially as some people that just copy trades mainly. There's nothing else again. Trust me, you're going to be profitable. So yeah, that's the first section. And I do hope you guys, were able to learn one or two things from, that section. So now we're going to talk more about, the risk management side and, the trading plan side as well. But before I do that, I want you guys to know that, joining classes are very, very important. Joining classes are very, very, very important. So please make sure that, in fact, take a screenshot of this so you know what classes are happening at what particular time. Every single day from Monday to Friday, there's going to be Mindset Morning. Very, very important that you attend this call. And guys, I want see, you might not believe this, but this Mindset Morning call changed my life. I know what I'm saying. Reciting those affirmations changed my life. Because me, I know where I was before I even started, affirmations and everything. So Mindset Money, please don't use it to play. There's going to be a accountability call every Saturday by 12 p.m. Very, very important that you join those calls. Risk management and psychology calls, mostly going to be taken by Umbuto. It's either going to be Saturday or Sunday. So depending on the day that it is going to be, it's going to be announced on the group prior. Withdrawal Friday is another very important thing that you should not be missing out on. Always check in at 7 p.m. every Friday. Then beginners call Monday, Wednesday, Friday. So if you're a beginner, please make sure you join this calls. If you're somebody that just started or you just joined the community, make sure you join, this calls by on Monday, Wednesday, and Friday. Make sure you join it and get some, very, very, very important information that is actually going to help you, see results long term. So yeah, guys, now we can move on to the risk management parts and trading plan. So let me actually now give you guys the blueprint on how to, apply proper risk management anytime you're trading. Let me give you guys the blueprint on how to, have a proper trading plan. So guys, give me a second while I switch over from my laptop to my phone. Quickly give me a second. Recording in. Okay, we should be good to go, guys. So I want to ask a question. Do you guys experience something like this? Maybe, you enter, so maybe you take two trades in a day. You take two trades in a day. The first trade, you made maybe $10. But the trade that now ends up losing, you lose like $30 or $40. Has that ever happened to anyone here? You use the same lot size or you use the same 0.01, but one trade you're making $10, the next trade you're making $30. Okay, so it has happened to a lot of you. Okay, now let me tell you how to prevent this, because a lot of you will be profitable if you knew how to calculate your profits and your losses. Very, very important, because this will give you an idea on trades that you should take and trades you should not take. So first and foremost, guys, I want everyone to download this app called FX Calculators. I want everyone to download this app called FX Calculators. This is where you are going to be calculating everything. This is where you're going to be calculating everything. You understand? I want you guys to download FX Calculators because it's a very, very important app for calculation of lot size and calculation of how much you're winning, how much you're gaining, etc. So once you download FX Calculators, this is how the app is going to look like. The main place where you're going to be using is this profit and loss section. So let's say, for example, a trade was dropped. So let's say, for example, a trade was dropped. Let's say we're told to sell gold. For example, now we're told to sell gold at 46.71. In fact, let's just use as 46.71. Let's say we're told to sell gold at 46.71. What do you want to do in this scenario? You want to know how much you're winning and how much you could potentially lose as well. That's the most important thing. You want to know how much you're winning and how much you could potentially lose as well. So let's say they say sell gold at 46.71. You come on to your FX calculators. What next do you do? So you come to profit and loss. Once you select profit and loss, make sure account currency is on USD. Make sure account currency is on USD. Once you click account currency on USD, you search for the financial instrument. So in this case, it's gold. So we search for XAUSD. Once we search for that, we select it. Now, if they tell you to buy, you click on long. If they tell you to sell, you click on short. So now we're told to buy. We're going to click on what? We're going to click on long. Then you see this place where it says standard loss. You want to click on it. Always make sure it says standard loss. Like these three menu bars, make sure it says standard lots. Some of you, it might say units. Some of you might say mini lots, but make sure it says standard lots when you're calculating for XAUSD. Now, I want you to put in the lot size you would normally use for your account size. Like what they tell you, okay, use this account size. So use this lot size for your account size. I want you to put that in. Then I now want you to put in the entry price. I want you to put in the entry price, 46.71. So put in the entry price, 46.71. Put in the exit price. The exit price is either the TP or the SL. You understand? So now we want to calculate how much we could potentially lose, first of all. So we're going to put in the SL. The SL is 46.74. So after we put in the SL, now we're going to see how much we could potentially lose. Wait, sorry, hold on. Nah, the SL is wrong. Oh, we're told to sell gold, not buy. What? So, guys, my apologies. So we're told to sell gold, not actually buy gold. Because I don't know, for some reason I saw sell, but we're actually told to sell gold. So if you put that, you put in, your entry price, put in your exit price, then now you can now see how much you would lose if this trade was to go and hit your stop loss. So now you can see how much you would potentially lose if this trade was going to go and hit your stop loss. So now you have a clear picture. Okay, I have $3. I have $3 that I'm going to lose. Is this $3 going to affect my account in a big way? You ask yourself that question, yes or no? Let's say you had $100. Let's say you had $100 and you decided to risk $3 on a trade. $3 out of $100 is not something that is going to shake you. You get. So this will even give you confidence of actually taking the trade and holding it. Because another thing that affects some of you guys take a trade, and before the trade even hits TP or before the trade hits SL, you guys are panicking and you're ending up and you're closing the trade, which in the long run is going to affect you because you're losing out on the trades that are, going to give you a lot of profits, and you're also cutting losses way too short when you shouldn't be cutting the losses. You get. Always allow your trade to hit TP or SL. And when you know how much you're risking, it gives you confidence that, okay, I've already accepted this loss beforehand. So there's no need for you to be panicking, if you get what I mean. So please make sure that if you are, trading, you always confirm your risk. Always confirm your risk. And you can also confirm how much you could potentially win as well. So you see that, okay, if this trade was to hit SL, you're going to lose $3. So now check how much you could potentially win. So if you want to check that, what you just need to do is to put TP where it says exit price. So you remove the exit price, the SL, then you now put the TP there. So now let's say you wanted to go for TP2. So TP2 is 46.66. So you could make $5 if this trade goes in your direction. So now that you know, okay, I could potentially make $5, and if the trade hits my stop loss, I'm only going to lose $3. Now, if you knew this before taking a trade, won't you have more confidence? Won't you be, a little bit more? Won't you be a little bit more, a little bit more calm when taking the trade? You're not fidget, trying to close a trade too early. You're not trying to, even be greedy as well. Once you know this, you're okay. Like you're okay from the get-go. So when you're taking the trade, you have a little bit of peace of mind, if you get what I mean. When you're taking the trade, you have a little bit of peace of mind. So before I proceed, does everybody get that? Before I proceed, does everybody get that? And if you have any questions, let me know in the chat box. If you have any questions, let me know in the chat box. What if we got a buy now signal? Okay, yeah, I'm going to give you guys, an explanation on how to actually do that as well. Okay, so I think that was quite clear. So let me share my screen once again. And let's go. So let me explain other different scenarios. So to put the long story short, this is how you calculate your risk. You understand? So beforehand how much you're risking, beforehand, how much you could potentially gain. If you have 100, and I'm going to talk about this, in the trading plan section. I'm going to talk about this in the trading plan section as well, because you should also know what is your limit in terms of how much you can risk depending on your account size. That one is also very, very important. But before I do that, somebody asked a very good question. What if, there's a signal, buy now? You understand? What if there's a signal saying, oh, buy now, rather than, buy USD card at this price? Because there's sometimes you will not get the entry price. They will not tell you the exit price, the entry price. So how exactly can you how exactly can you know how to calculate your risk in that type of scenario? So guys, give me a second. Okay. So let me quickly share my screen once again. So you guys should be able to see my screen now. So how do you now calculate your risk if it is, buy now or sell now? They tell you, oh, buy now, sell now. There's no entry price. It's not a pending order. It's a market execution. They just say buy now. How do you now calculate your risk? It's very simple. You come to your MT5. You click on the currency pair. So let's say in this case, I can't even trade because we're in the week. Okay, I can.
So once you do that, once you come to your MC5, click on trade on the currency pair. Now, you guys can see that there are two numbers here, two sets of numbers. There's a set of number that is above sell by market. There's another set above buy by markets. Now, I want you to look at this number that is just above sell by market, 1.36706. 1.36706. That is the current market price. So that means that is where the market is currently floating around 1.36706. So that is now what you're going to put where it says entry price. So whatever number you see here at sell by market, that is now going to be your entry because that is where the market currently is. So you're going to put that at your entry price. Then you're now going to put your stop loss once again. So you're going to put your stop loss. So let's say our stop loss in this scenario is 1.36000. Puts in the lot size you would normally use, and you can see what? Oh yeah, USD card. I forgot to change the currency pair. So yeah, USD card. We've put in our entry. We've put in our stop loss. We've put in our lot size. Now, you guys can see that this is the amount we could potentially lose if this market was to hit our stop loss. So what you're going to do, you want to come here, collect your entry from here, just above sell by markets, and you want to put it here at the entry price, then put your stop loss, carry your stop loss, put your stop loss, and once you do that, you are good to go. Put it here, and it will calculate your risk for you. As you can see in this scenario, we could potentially lose $5. If you also want to calculate how much you could potentially gain, let's say the take profit was 1.37500. Let's say that was the take profits. Maybe that was CP1. You can see that, TP1, if TP1 hits, I could potentially make $5.8. Then you now make the decision, okay, do I want to take this trade or do I not want to take this trade? Once you make that decision, and of course, you have to be fast, of course, and you place your trade and you're good to go. So now you have that peace of mind knowing, okay, if this trade hits stop loss, I'm only risking $5. If this trade hits take profits, I potentially could make, $5 as well. So I hope that's clear. Does everyone understand? I hope that is clear. Does everyone understand? Somebody asked another very good question. When a trade is given, before we calculate it on the calculator, it might have reached CP or SL. Now, I'm going to show you how to be very fast in calculating your risk. Because me personally, I don't use FX calculator. Like, I use my head. Like, it's very simple. Like, immediately I say signal, I already know how much I could lose and how much I could gain. I don't use the calculator. But as a beginner, you need that calculator in the beginning. You need it. But I'm also going to show you another fast way, especially for trades now like gold. They move quite fast. Currency pairs, they don't move that fast, so you can actually take your time to calculate it. But pairs like gold, they move very fast. So you need to be quick in executing. But let me see if there are any other questions before I move on. Sorry. Okay, no questions for now. So, from what I can see, all of you understand, the first two examples where you are giving the entry price and you're not giving the entry price. I think it's quite simple to understand. Now, another example is when you have like pending orders like this. Set a buy limit on GBP JPY at this particular price. You understand? So it's very, very simple. They would already tell you the price. They're already telling you the price. All you just need to do is to come here, look for the currency pair, GBP JPY, select it. Once you get that, put in the lot size you would normally use, 0.01 or 0.02, whatever you want to use. Then put in the entry price 21.000, then put in your SL. So let's say the SL was 21.0.200. You can say, okay, if this trade was to hit SL, I would lose $10. Okay, you know that now. You can calculate your take profit as well, 21.900. And you see how much you could potentially gain if the trade was to hit, take profit. So, guys, I think this side, like this area of calculations, is quite simple. All of you understand it. If they're telling you to buy, click on long. If they're telling you to sell, click on shorts. Put in the exits. Put in the entry and put in the exit price, and you are good to go. So now, I want to talk about how, even though this is very important, this is very, very, very important. The most important thing is actually knowing what your accounts can carry. The most important thing is knowing what your accounts can carry. So I'm going to be talking about that now. Then after I finish that, then I'm now going to talk about how you can actually calculate your risk very, very fast, like without wasting any time. Although that one will need you to actually practice, like you need to practice and get used to it. But, I'm still going to show you guys. So now, remember I talked about, having a trading plan and, basically saying how important it is to have, a proper trading plan. Because if you don't have a trading plan, you are not planning to succeed. If you don't have a plan, you plan to fail. If you have a plan, you plan to succeed. So how exactly can I have, a trading plan that works for my account size? Because everyone here has, everyone here has different, account sizes. So what should you use according to your account size? How much should you be risking according to your account size? How much should you be risking according to your account size? What should be your daily targets? What should be your stop loss limits, etc. So now let me explain. So each and every single one of you here have different account sizes. You have different account sizes. So how do you now set up a trading plan in the way where you're actually seeing good and consistent growth, and you're not blowing your accounts? Because guys, anytime someone tells me they have blown their accounts, I just know that they don't have a trading plan. Because if you have a proper trading plan, it would be nearly impossible. I'm not going to say it's impossible, nearly impossible. Like, you have reduced your chances of blowing your account from 100% to 5% just by having a plan and following that plan. So how do you now craft up a proper trading plan? First things first, guys, you need to make sure you have a fixed amount you risk per trade. This is the most important thing. Have a fixed amount you risk per trade. I remember talking at the beginning of the call, or somewhere near the beginning of the call, I was basically saying that some of you make $10 on one trade, the next trade you're losing $40. It should not be like that at all. It shouldn't be like that at all. You understand? You should have, so if you're having losses, the losses should be consistent. Like, if you're losing $10, you should only be losing around that range of $10. You shouldn't be losing $10 on one trade and on another trade you're losing $500. No, that's not how it should be. You should be consistent. Like, the loss is not that you should be losing consistently. Or no, please. Not that you should be losing consistently. No. But if you take a loss and you take another loss, the losses should look identical. That's what I'm trying to say. The losses should look identical. So if you're losing $10 on one trade, you should be losing $10 on another trade. So you need to have a fixed amount you risk anytime you take a trade. So now, for example, let's say you have $100 sitting in your trading accounts. Let's say you have $100 sitting in your trading accounts. You should have a maximum risk per trade of 10 to I can't even say 10 to $15, to be honest. $10 to $15, to be honest, if you have $100 accounts. Now, the reason why I was like initially stopping myself from saying $10 to $15 because I know how crazy gold has been. And most of you trade gold. And to be honest, right now, trading gold is funny because 100 pips is now the new 10 pips. 100 pips is now the new 10 pips. So sometimes the SLs can be larger, you get, but still have a fixed amount you are risking per trade, you get. If we put gold aside and silver aside, at least for now, because eventually it's going to go back to normal. $10 to $15 is what you should be risking per trade. You understand? $10 to $15 is what you should be risking per trade if you have $100 in your trading account. So what does this simply mean? If you see a trade that exceeds that $10 to $15 threshold, you know that is not a trade you should not take. That is a trade you should not take. You understand? You know that is a trade you should not take. One thing a lot of you don't realize is that it's not every single trade you see that you can take. Like, it's not every trade that is going to flow with your account size. It's not every trade that your account size can carry. Me personally, I've not been dropping a lot of signals of recent because I wanted to have this call first. I wanted to honestly have this call first because I wanted you guys to understand, because me personally, I'm not really a scalper, someone that likes holding trades a lot. So if I drop a gold trade now, if I drop a gold trade now, because of how crazy gold has been, you can see 400 pips stop loss, 300 pips stop loss. You get, even though the take profit level can be 1,000 pips take profit level, still that stop loss of 300, 400 pips is a lot for people with $100, because 300 pips, 400 pips, that's what, $30 to $40 risk on one trade. And I know a lot of you don't even calculate your lot size. Some of you might not even use 0.01. Some of you might use 0.03. And your accounts will not blow. I beg, let someone not be held responsible. You get. I don't want to be held responsible for that. So that's why I said, okay, I must have this call first so that you guys can understand. Because if you have $100 accounts, you should not be taking a trade that has 300 or 400 people sell. Somebody that has $1,000 in their trading accounts, they can take that because they have, more capital. They can take that because they have more capital. If they lose $30 or $40 out of their trading accounts, it's not going to stab them. Like, they're not going to feel it like that. But if you have $100 and you're losing $30 or $40, you're going to feel it. You understand? You're going to feel it. So you need to have a risk that a fixed amount. I really want you guys to understand this. A fixed amount that you risk per trade. Very, very, very important. You need to have a fixed amount that you risk per trade. Now, once you have this fixed amount, any trade that doesn't give you that target, or surpasses that threshold, you don't take. Then any trade that falls within that threshold, you can take. And again, you should have a daily loss limit. A daily loss limit. Guys, I know right now, like, see, the market is currently in a phase where, I don't know, it's in a strange phase. Not that it's bad, or not that the market is bad, but it's so easy now to make it's so easy now to make a lot of money in the market. Like right now, it's so easy because with gold will give you 2,000 pips in one day. Just with 0.01, that's $200. You get. So it's so easy to get caught up in that. But I want you guys to know that long term, having a proper plan is what is going to save you. So don't get too infatuated with what gold has been doing of recent. You get. But then again, you should have a profit target depending on your account size. So if you have $100, I mean, if you make $15 to $20 in a day, you should be fine. If you make $30 in a day, you should be fine. You should not be looking to double your accounts every day. If you get what I mean, you should not be looking to double your account every day. Once you make a certain percentage, stop trading for that day. You make $20 in a day, you stop trading. $20 in a day times 5, that's $100. In a week, you double your account and you have consistent growth. Not that you make $100 today, tomorrow you're blowing your accounts. You want steady and consistent growth. You understand? You want steady and consistent growth. So have a fixed amount. Okay, once you reach this particular profit target for the day, you stop trading. Some of you, I know in the group, in a day, we can drop like 8, 10 signals, depending on the day. Depending on the day, yeah. Or maybe sometimes, let me say 5 to 10 signals, depending on the day. Some of you only just need one trade to hit your daily profit targets, and you stop trading. Because at the end of the day, what is better? Taking one trade and making $20, or taking 10 trades and making $20? Because let's say, for example, you take all of the 10 trades in a day, and maybe that day is not even a good day. Maybe it's not all the trades that went well. And at the end of the day, you only ended up making $20 or even less than that, maybe $10. What do you think would have been better? Is it not just to take one trade, make the money that you want? You don't need to enter the market again. You can go and do other things with your life. You can go and even enjoy the profits. Go and buy whatever you want to do. Rather than being on your phone 247 and monitoring the market, trying to make all of the money at once. You get, so having a profit target is going to really save you. So once you hit your targets for the day, you stop trading. Another thing as well, have a daily loss limit. Once you hit your daily loss limit for the day, stop trading for that day. Once you hit your daily loss limit for the day, stop trading for that day. Stop trading for that day. You understand? Now, all of these figures that I used, like they are just rough sketches. You don't have to follow them to the T. But the idea I'm just trying to paint is that you should just have a fixed amount you risk per trade, number one, a daily profit target and a daily loss limit. It is very, very, very important. You need to have a daily profit target and a daily loss limit. It is very important. So these figures, at the end of the day, you can tweak them to your own accord. But I would personally recommend whatever you are risking in a trade, it should not pass 10% of your accounts. That's just my own personal recommendation. Whatever you're risking on a trade, it should not pass 10% of your account size. Now, why do I say this? Because if you're risking more than 10% on one trade, the likelihood of you blowing your account has increased. Now, if you're risking 10% on one trade, or anything around that 10% on one trade, and let's say you have $100 in your trading accounts, you're risking 10%, which is $10 per trade. It will take you 10 trades to lose your whole account. And I'm sure some of you have been on the group for a while. There has never been a time where we will lose 10 trades in a row, or we'll go on a consistent losing streak of even 5 trades. We have not even seen 5 trades in a row lose. I think the most on this group is 2 trades, 2 or 3 trades that have lost in a row. But then on the next trade, there's potential to even make all of the losses back, depending on the TP you go for. So having this 10% threshold is going to stop you from blowing your account, because even if you lose 1, 2, 3 trades in a row, your accounts will not blow. So you can take the next trade and now start to recover all of the losses that you've already made. So this is what is going to give you a buffer. You don't want to risk anything more than 10%, because if you risk more than 10%, you're putting yourself in a pickle, because you're giving more room for your account to blow. Basically, that's just what you're doing. So always give yourself this is what I call it. Always give yourself a 10 trade buffer. So that means you will need to lose 10 trades in a row for your account to blow. Always give yourself a 10 trade buffer, no matter your account size. Minimum, I not say that's the maximum. That's the minimum you should do. Minimum of 10 trade buffer. If you have a bigger account size, you should give yourself even like a 20 trade buffer. If you have a bigger account size, give yourself a 20 trade buffer. Like now, if you have $1,000 in your trading accounts, give yourself a 20 trade buffer. So this is basically you risking $50 per trade. You need to lose 20 trades in a row for that account to disappear, basically. So give yourself, the bigger your account size, the less you would have to risk. So if you have $1,000, you can give yourself at least a 20 trade buffer. If you have $100, nothing less than a 10 trade buffer. If I say give yourself a 20 trade buffer on $100 accounts, that's basically you risking $5. Let's be honest. Even with currency per se, risking $5 on one trade, no, that's too small. But minimum 10 trades, 10 trade buffer. You understand? On $100 accounts. If you have $1,000 accounts, you can give yourself a 20 trade buffer. If you have a $10,000 accounts, give yourself more than a 20 trade buffer. I don't even know the figures if you can give yourself, but give yourself a very good buffer. But yeah, does everyone understand what I've said so far? I've just been talking without checking the chat box. Does everyone understand what I've said so far? Okay, perfect. So everyone is following along. Everyone is following along. Okay, perfect. So now that you know that you need to have a plan, you need to know what you're risking per trade. Now, I want to give you guys a scenario. I want to give you guys a scenario. So let us say, so we're going to go back to FX calculators. Let us say a trade was dropped. It was on gold. A trade was dropped and it was on gold. They told us to sell gold. And we use 0.01 to check our how much we're risking. And they told us sell gold, and this was the entry price. The entry price was 4100. Let me use current market price. The entry price was, let's say buy gold. They told us to buy gold. The entry price was 4700. The SL was 4690. And yeah, they told us to buy gold. This was the entry price. This was the SL. You can see that we're risking $10 now on this trade. We're using 0.01. Now, if we change this SL, let's say the SL now was what? 46.50. Can you see that now you are risking $50? Can you see that now you're risking $50? You're still using the same lot size of 0.01, but you're risking $50. Can you guys see? Now, this should let you know that your lot size, it doesn't really matter. What matters is that trade that you've taken or that trade you want to take. What is the stop loss size? How big is the stop loss? Is it 100 pip stop loss? Is it 200 pip stop loss? Is it 500 pip stop loss? That is what is important. That's why I said some of you take a trade, you're using the same lot size. One trade, you're making $10. The next trade, you're making $40. This is the reason why. Because different trades will have a different stop loss size. You can get a trade now. The trade is only 100 pip stop loss, which you're risking $10. You can get another trade and the trade is 500 pip stop loss, which you're risking $50. This is why you always need to check. It is very, very important that you check. If you don't check, this is how you start taking trades that your accounts cannot handle. If you have $100 in your trading accounts, you put 0.01 there. Oh, you think, okay, because of his 0.01 is the smallest lot size, my accounts will not blow. But the SL was 1,000 pips. You see that you're risking $100. Can you see? You see that you're risking $100. This is where a lot of people get it wrong. This is why you always need to calculate your risk. If you calculate your risk and you see, oh, I have $100 in my trading account, I'm risking $50. That is more than what I can afford to risk on this particular trade. What do you do in this scenario? Once you figure out that, oh, this is more than what I should normally risk on my account size, what do you do in that scenario? Let me know in the chat box. What do you do in that scenario? Let me know in the chat box. Once you see, oh, this particular trade, I cannot risk $50 on my account size. What do you do? Somebody said move SL. Are you following us? Move SL to break even, okay? Reduce your SL. No. Very simple. Don't take the trade. You don't take the trade. You ignore the trade. It's very simple. Who said move stop? Who said? Oh, forgive me for laughing, but that's so funny. You don't move stop loss to break even, no, Pico. No, you don't take the trade because why? You don't take the trade. Why? Because it is more than what you can risk on that particular trade. Remember, have a fixed amount you risk per trade depending on your account size. Once you have that fixed amount, any trade that goes above that amount, you don't take it. You understand? You don't take it. You don't take it. So this is why you always need to check how much you're risking. And there are also going to be scenarios where, you need to even use a higher lot size because of the stop loss is so slim. So now let's say there was a trade given and the stop loss was what? 46, 46, let's say 46.90, 98. Let us say 46.98. Now, guys, I want to ask you a question. If you normally, when they say, okay, use this lot size according to your account size, what number would they say for $100? Like now, when they're telling you, okay, use this particular lot size if you have $100, what is the lot size that they would normally tell you? 0.01. Okay. Now, if you are still sticking to the threshold of risking $10 per trade, nothing more than $10 per trade, and you take this trade now, the entry price is 4700, the stop loss is 46.98, and you put in the 0.01 lot size, you can see that you're risking $2 here. So what will you now do? You increase your lot size to 0.05. You can see here with 0.05, you're risking only $10. With 0.05, you're risking only $10. Can you see now that lot size does not lot size matters, but it doesn't matter to the point where you guys think. Like you guys just think, okay, if I use the minimum lot size, I don't need to worry. What you need to worry about is how much you're risking per trade. You understand? So in this case now, we can use 0.05 rather than $10. You can use 0.05 rather than $10. Sorry, what am I saying? You can use 0.05 rather than 0.01. Why? Because it's 0.05 that is going to give you this, minimum risk of, or rather maximum risk of $10 per trade. You get. So you can see that, you should always calculate how much you're risking per trade. So you can even know the appropriate lot size to use. There are some scenarios where you can use 0.05, and there are some scenarios where you can use only 0.01. But you're never going to know that if you don't actually take your time to calculate how much you are risking on that particular trade. You understand? You will never know if you don't take your time to actually calculate your risk. So does everyone understand that part as well? Does everyone understand that part? Okay, perfect. You guys are following. So I feel like there's still some things that I need to cover, but I'm already running out of time. So I'm just going to be very, very fast. I'm just going to be very fast. But I believe you guys understand the picture that I'm trying to paint. Make sure you calculate your risk, because once you calculate your risk, you know the lot size to use. You know if you can take that trade or not. Have a fixed amount you should risk per trade. Have a fixed amount you should risk per trade, and always stick to it. Always stick to it. Now, depending on your account size, me personally, I would recommend that you should ask, the person that registered you to give you, more guidance depending on your account size. Because, like I said, all of you have different account sizes, on the risk you should be risking per trade. Like that, if you have $500, ask your coach, ask the person that registered you, how much you should be risking per trade. And if you do that, they will be able to assist you more. But yeah, I think, I just need to explain some more things. Then we're going to call it a day. But I hope everyone is understanding what I'm saying so far. I hope everyone is understanding what I'm saying so far. But yes, guys, make sure you have a fixed amount to risk per trade. And when you have these fixed amounts, another thing you should take note of, when you have this fixed amount, stick to it. Even if you lose 2 trades in a row, stick to the fixed amounts. You understand? Stick to that fixed amount. If your fixed amount is $10, always use the lot size depending on that trade that is going to give you a stop loss of $10. So let's say now you take one trade, using 0.01. If the thing hits stop loss, you're going to lose $10. You want to make sure, okay, it's always on that $10. And maybe another trade is given. It is not going to reach $10. Maybe if you use 0.01, it's not reaching $10, reaching $5.
increase that lot size to 0.02 so that it can reach $10. If you use, maybe you have a bigger account size, maybe you have $200 now, and maybe your own risk per trade is $20. And if you're using 0.02, it is what? Going to cost you $40. You reduce that lot size to 0.01 so that it can meet $20. You understand? Always make sure you stick to that fixed amount to risk per trade and adjust your lot sizes accordingly, depending on the stop loss size of the trade that you're going to take or the trade that you want to take. You understand? I hope that English is, I hope that I hope that was like easy to understand. I hope that was easy to understand. Does everyone get it? Does everyone get what I've said so far? I hope that was easy to understand because I know it can get confusing sometimes, but I just hope that was easy to understand. Okay, you guys understand it. Okay. Okay, perfect. So now moving on. Everyone knows how to calculate their risk. Perfect. Now I want to show you guys because somebody asked in the chat box, like, how do you know the PEEP? How do you know the PEEP counts? How do you know, how many pips the SL is, etc., etc. So let me even explain that. Let me explain that. Give me a second, guys, while I share my screen once again. So, guys, this should be very simple to understand because I've already written it down. So yeah, this is the last thing. Then we're going to call it a day. So, so someone asked how to calculate pips. Another person also asked. Initially, I think like 20 minutes ago, someone asked how they can do it in a faster way, like calculate their risk in a faster way, because sometimes trades are very, very fast. Trades are very, very fast. Now, guys, this one, please make sure you pay attention. So for gold, so I'm only going to do this for gold because gold is really the only thing that moves that fast that you need to like enter immediately. Currency pairs, don't worry, you can take your time. Calculate your risk the traditional way and enter. But for gold, you need to be very, very fast. So let me explain this. So how do you know, if gold is, maybe has moved 50 pips or has moved 100 pips or has moved 200 pips? It's actually very, very simple. So we all know that gold has 4 figures predominantly. Like right now, it has 4 figures. Maybe when gold reaches $10,000 per ounce, we'll do another video. But right now, gold is around the 4,000, 3,000, 4,000, 5,000, 6,000, depending on when you're watching this video, Sha. But, gold predominantly has 4 numbers. So sometimes if you're taking a trade, you see, okay, maybe the entry is 47.20, take profits is 47.25, or maybe stop loss is 47.25. Now, I want you to understand that the distance between 47.20 to 47.25 on gold is equals to 50 pips. So if gold moves from 47.20 to 47.25, it has moved a total of 50 pips. I'll say that again. If gold moves from 47.20 to 47.25, it has moved a total of 50 pips. It has moved a total of 50 pips. If gold moves from 47.20 to 47.25, it has moved a total of 50 pips. If gold moves from 46.86 to 46.89, it has moved a total of what? 30 pips. It has moved a total of 30 pips. If gold moves from 46.80 to 46.76, it has moved a total of 40 pips. Now, let me check gold's current market price. Hold on. Let me check gold's current market price. So gold current market price is what? 49.68. So gold currently is at 49.68. If gold moves from 49.68, to
49.69. This is 10 pips. This is 10 pips. From 49.68 to 49.69 is 10 pips. From 49.68 to 49.90. Oh, what am I saying? 49.70 is what? 20 pips. So from 49.68 again to 49.75 is what? Let me know in the chat box. From 49.68 to 49.75 is how many pips? Let me know in the chat box. Drop your answers in the chat box. Hunter should not be the only one answering. Oh. Drop your answers in the chat box. 70 pips. 70 pips. What if I told you you were wrong? 70 pips. And are you guys just copying the same answer? Somebody said 80, 70. Okay, 7. No, it's not 7. It's 70. 70 pips. 70 pips is actually the correct answer. See, just count it like this. So 49.68 to 49.75 is 70 pips. You understand? 70 pips. To put it very simple, 68 to 69 is 1. Just add a 0 at the back. 68 to 70 is 2. Add a 0 to the back, and that will give you 20 pips. 68 to 75 is 7. Add a 0 to the back, that will give you 70 pips. So you can just you can literally just bring out your fingers, count. So 16, 68, 69, 70, 71, 72, 70, 73, 74. Am I tweaking? Sorry. 69, 70, 71, 72, 73, 74, 75. That is what? 7. 69, that is 1. 69, 70, that is 2. 69, 70, 71, 72, 73, 74, 75, that is 7. Then just put 0 at the back. So that's now what? 70 pips. So count from 49.68 to 49.75. So you start from 69, 70, 71, 72, 73, 74, 75. That is 7. 7. Then you add a 0 at the back. 70 pips. Now, let me ask you guys again. 49.55 to 49.60 is what? 49.55 to 49.60 is what? 50 pips. 50 pips. Exactly. So it's very simple. It's very, with gold, it is extremely simple. Like, I don't need to go to FX calculators to calculate gold. You understand? I don't need to go to FX calculator. Oh, where have I gone to now? I don't need to go to FX calculators to calculate gold. I don't need to go to FX calculators to calculate gold. So it is very, very simple. Extremely simple. Anybody can do this. You get? So now let's say there was a trade given. Let's say there was a trade given. Yeah, let's say there was a trade given. Buy XAU USD now. TP1 is 49.70. TP2 is 49.80. SL is what? SL is 49.60. Abi? Oh, sorry. Let's do this instead. So TP1 49.80, TP2 49.90, SL is 49.60. Let's say you immediately see this notification on your phone. Okay, buy XAU USD now. What should you go and do? What should you go and do? You go to your MC5. You go to your MC5. You click on trade. You see, oh, you can see above sell by market. Okay, the market price is 49.68. You check the stop loss. Stop loss is 49.60. In your head, you should already do the math. The distance between 49.68 to 49.60 is what? Who can tell me in the chat box? What is the difference between 49.68 and 49.60? What is the difference? Who can tell me what is the difference? 80 pips. So now you see, it's 80 pips. So without you going to FX calculators, you already know, okay, this thing is 80 pips. So this thing is 80 pips. You literally, all you just have to do is to count. Just count. So from 68 to 40, you count 7, 6, 5, 4, 3, 2, 1, 0. That's 8. Put a 0 at the back, 80 pips. Now that you know this, you don't need to go to FX calculators. So now that you know this, you can easily execute immediately. You can easily execute immediately. Now, let me explain how pips work. Now that you understand how to calculate the pip distance, let me explain how pips work. So, when you're trading, every 10 pips equals to $1. You understand? When you're trading, every 10 pips equal to $1. So, that means if you're using 0.01, 10 pips equals to $1. You understand? 10 pips equals to $1. 30 pips equals to $3. 50 pips equals to $5, and so on and so forth. If you're using 0.02, it is double of 0.01. So that's what? 10 pips equals to $2. 30 pips equals to $6 if you're using 0.02. If you're using 0.03, 10 pips equals to $3. 30 pips equals to $9. You understand? If you're using 0.04, 10 pips equals to $4. 30 pips equals to $12. Because 20 pips, what is 2 times 4? 2 times 4 is what? 8. 3 times 4 is what? 12. So I hope that makes sense. Oh, I'm sure all of us passed maths when we were in secondary school, so I don't think this should be hard. But yeah, I hope that makes sense. You understand? So if 10 pips for 0.01 equals to $1, and let's say I have $100 in my trading accounts, and I'm taking this trade, and I use 0.01, how much could I how much is it in dollars? How much is it in dollars? Is it $16? Is it $12? How much is it in dollars? Let me know. $8. Exactly. $8. So that's very simple. Now, what if I was using 0. Let's say there was another trade now that was giving 100 pips with 0.01. How much is that in dollars? How much is that in dollars? How much is that in dollars? 0.01 with 100 pips, $10. Exactly. So now, okay, what if it is now 0.02? What if it was 80 pips with 0.02? How much is that in dollars? 80 pips with 0.02. How much is that in dollars? $16. Okay, good. Now, 140 pips with 0.02. How much is that in dollars? How much is that in dollars? 140 pips with 0.02. How much is that in dollars? That's today I go know. It's today that I will know who was good in math in secondary school. $28, exactly. $28 is the correct answer. $28 is the correct answer. So, guys, you guys can see it's just very, very simple. It's just simple mathematics. Very simple mathematics. We're not doing further maths here. Very simple subtraction and addition and multiplication. It's very, very, very simple. You understand? This is very, very simple. Now, I want to ask you guys another one now. If it was 150 pips with 0.03 now, how much would that be in dollars? How much would that be in dollars? $0.03 with 150 pips. How much is that in dollars? $45. Exactly. Very simple. Very, very, very simple, guys. So I'm sure you guys now understand the gist. I'm sure you guys now understand the formula. I'm sure you guys now understand, everything. So it's quite simple. Now I want to ask you guys another question before I round up so that I know that you guys actually understand. So what is the distance between 4968 to 4983? What is the distance in pips? How many pips is this? 4968 to 4983. How many pips is this? How many pips is this? 4968 to 4983. How many pips is that? Let me know in the chat box. How many pips is that? 4968 to 4983. How many pips? Remember, counts. Let me see the answers in the chat box. So somebody said 130, somebody said 140, somebody said 150, 150, 150, 150. So now let's count. So 4968 to 4983. So 69, 70, 71, 72, 73, 74, 75, 76, 77, 78, 79, 80, 81, 82, 83. That's 150 pips. That is 150 pips. So that's very simple. So 150 pips. Okay, no problem. Now, 150 pips with 0.04. How much is that in dollars? 150 pips with 0.04. How much is that in dollars? $60. Exactly. Perfect. So now, guys, you guys can see this thing is not simple. Sorry, this thing is simple. This thing is simple. This thing is not complicated. It's very simple, very easy to understand. Like this now, you don't need to stress yourself. Anytime you want to enter a trade, you already know. Like you already know beforehand. Even if the trade is very fast, you do this math in your head. You know the lot size to use. You know if you can take the trade or not. You know if it fits your account size. You're having more peace of mind because you know what you're doing now. Sure, you get. And the more clarity you have, the more money you'll be able to make, the better decisions you're able to make. So I hope everyone understood this. And if you have any questions, let me know. Also, if you're watching this video and you do have any questions, please do not feel shy to ask. If you're watching this video and you have any questions, do not feel shy to ask. Reach out to whoever send you the link to this video, and they'll be very, very happy to help.